Hi students, today we are going to unlock the language of accounting. We're going to learn the first two words of accounting, which are the foundations of accounting moving forward. So what's the first word? It is debit. So you're asking yourself, what does debit mean? Well, it has a very simple definition. It's called left, and we find all debits in the left column. So debit is the first word. The second word is credit. Credit has an equally simple definition, and it is right. Credits go in the right column. When all debits equal all credits, then the transaction is in balance. This is called double entry bookkeeping or double entry accounting. So you're going to learn that for each debit, there is an equal and corresponding credit. Now remember my accounting professor, first one that I had, explaining to me that this would be the hardest concept to learn in accounting, and once I mastered it, then everything else would fall into place, and I know the same is going to be true for you. So we've learned what debits and credits are. They're left and right. Now we're going to learn the accounting equation. It is assets equal liabilities and owner's equity. So everything on the left side of the equation, all assets, carry a normal debit balance because, again, they're on the left side of the equation. On the right side of the equation, we find liabilities and owner's equity, and therefore they carry a normal credit balance because they're on the right side of the equation. Again, sticking to debits are left, credits are right. So how do debits and credits impact the accounting equation? Well, first, let's remind ourselves of what the accounting equation is. It is assets equal liabilities and owner's equity. So remember, left side are debits. Assets carry a normal debit balance, so debits are going to increase the balance, while credits decrease the balance. Let's move to the right side, which represents our credits. Credits increase the balance, and debits decrease the balance of accounts on the right side. So we've talked all about liabilities, assets, owner's equity, but we have said nothing about revenues and expenses. So where are they represented in the accounting equation? Well, they actually live in owner's equity. So let's delve a little deeper into owner's equity and see what makes up that account. Well, we start out first with the beginning owner's contribution. That can be either cash or property, the value of property, and that's what we use to start our company at the beginning. The next thing that adds to our owner's equity account is a net profit, and this is when our revenues are greater than our expenses. What takes away from owner's equity? Well, a net loss would. That's where revenues are less than expenses. What else adds to owner's equity? Well, if later down the road our owner needs to put in additional funds, that would add to owner's equity. The last thing that impacts owner equity is when our owner takes distributions. That would reduce owner's equity. So this calculation then brings us to the ending owner's equity balance. So how do we know whether revenues and expenses are debits or credits? I think this we can figure out pretty easily. Remember the slide before we talked about the equation of revenues minus expenses equal either a net profit or a net loss. So a net profit means that revenues are greater than expenses. A net loss means that revenues are less than expenses. So owner's equity is on the right side of the equation, which means it carries a normal credit balance. So net profit increases owner's equity because it is a credit. And so net profit is a net credit where our revenues, which are a credit, are greater than our expenses, which are a debit. Or A net loss decreases owner's equity because that is a debit. A net loss is a net debit, and that's because our revenues, which are credit, were less than our expenses, which are a debit. So let's put all of these pieces together in the accounting equation. The left side, debits, those are our assets because they carry a normal debit balance. The right side are credits. They are represented by our liabilities and our owner's equity. We've learned that owner's equity has multiple parts. Credits increase owner's equity. Those would be owner's contributions, whether they are the initial contribution to start our company or additional contributions in subsequent years. Net income increases owner's equity because our revenue, which are credits, are greater than our expenses, which are debits. Debits decrease owner's equity. That would occur when we give or distribute any money to our owners, and if we have a net loss where revenues, which are credits, are less than expenses, which are our debits. Okay, so now let's make all of this really easy. We're on the left side. We know they're debits. We've learned assets carry a normal debit balance, and we've learned expenses carry a normal debit balance. We've learned that debits increase the account balance and credits decrease the account balance. Let's move to the right side. Right side are credits. That includes liabilities, owner's equity, and revenues. Credits increase the account balance. Debits decrease the account balance. So now we've learned all sorts of really cool stuff. We've learned debits and credits. We've learned the accounting equation. We've talked about assets, liabilities, owner's equity, revenues, and expenses. But what are we going to do with all of this cool information that we've learned? Well, we're going to use it to create financial reports. And these reports are going to tell us the financial health of our company. So the first report we're going to look at is the balance sheet. A balance sheet is always as of a point in time, meaning a specific date. So we're using Paul's Guitar Shop as our example. You can see a balance sheet and it says December 31st, 2015. So it is as of that specific date. Now let's talk about the left side, our debits, and what do we find on the left side? Well, we find assets, don't we? What's on the right side, which are our credits? We find liabilities and we find owner's equity. Well, a balance sheet does exactly what its name tells you that it does. It must be in balance. We've already learned that assets equal liabilities plus stockholders or share owners' equity. So let's look at this example and see if this is holding true. Total assets, $171,900. Let's look on the right side. Total liabilities and owner's equity. Also $171,900. So therefore the left side equals the right side. Remember I said first when we started our presentation that for every debit there will be a corresponding and equal credit. And so we've just now proven that with looking at this balance sheet. So we have a second type of report that we're going to discuss, and that's called an income statement. An income statement is for a specific period of time, no longer than a year, but you can also have income statements, interim statements for a month, a quarter, maybe semi-annually. Also, you can do comparison statements where you'll compare the results of one year to that of another year, normally the previous year. So let's look at how Paul's Guitar Shop, the income statement is set up, and you can see it is for the year ended December 31st, 2015. So we first start with revenues, and do we remember what revenues, what normal balance they carry? That's right, they carry a credit balance. Next are expenses, and what kind of a balance do they carry? Well, they carry a debit balance, don't they? So now let's look at the results. So our revenues for this year for our guitar shop was $27,800. Our expenses were $14,850. Well, $27,000 minus $14,000 means that we're going to have a net profit because revenues were greater than expenses of $12,950. Here's our net income. And if you remember, net profits carry a credit balance because revenues, credits, are more than expenses, which are debits. So a net profit, being a credit, increases the account balance of owner's equity. So now we have gone through and unlocked that mysterious, wonderful language of accounting.